Banks used to be a sweet investment. Lots of tasty dividends, even if there was little growth. It all went sour in the 2008 crisis though. The dividends disappeared, and so in some cases did the banks themselves. Since then, the banks and their regulators have been after a way to restore the balance.
Think of a bank as a set of scales. Its money in and money out must always balance.
On one side is the money that goes out to borrowers. Banks lend it out to home buyers, companies, credit card holders, governments, and even to other banks. On the other side is the money that comes into the bank. That comes from two main sources. First are the people who lend money to the bank, like depositors. Second are the shareholders, who provide the equity, also known as capital.
Banks prefer to fund themselves with more depositor money than shareholder money. That's partly because shareholders expect to earn a better return on their money than depositors do, but also because banks are measured on their return on equity. The more equity you have, the harder it is to make a good return.
So how much shareholder money or capital does a bank actually need? Well, that lies at the heart of the debate between the industry and the regulators. Imagine that some of the loans go bad and that the bank never gets the money back. Remember that the two sides have to balance, so if something disappears from one side, something also has to disappear from the other. And banks must protect their depositors, so if loans go bad, it is the shareholders who must lose out. The bank needs enough shareholder money to be able to absorb all the potential losses. If the bank runs out of shareholder money, it goes bust.
And so the banks and the regulators argue endlessly about the scale of the potential losses, and that depends on who the bank has lent to.
Imagine that the bank lends exclusively to risky borrowers, credit cards, small business loans, that sort of thing. These loans earn high interest rates, but are more likely to default, so banks need a lot of shareholder money to cover the potential losses. Now instead, imagine that the bank lends much more conservatively, to governments or to mortgages where there is the security of a house. The interest rates charged are lower, there is a lower risk of a loss, so the banks can hold less shareholder money.
So everything depends on how risky the loan book is. This is summed up in a figure called risk-weighted assets, which is an appalling piece of banking jargon. The amount of shareholder money or capital that the bank has to hold is usually expressed as a percentage of risk-weighted assets. The less risk-weighted assets the bank has, the less capital it has to hold.
The regulators have models for how risky some types of loan are, but most big banks prefer to use their own internal calculations, which, unsurprisingly, show that their loans are less risky than the regulators' models suggest. Most banks have capital of between 10 and 15% of risk-weighted assets. As a broad rule of thumb, the higher the capital ratio, the safer the bank is, but the harder it will be for the bank to generate an attractive return on equity. So where does Lex think the balance lies? Well, when it comes to bank capital, it is definitely not a case of less is more. Banks with relatively high levels of capital tend to attract relatively high stock market ratings. Shareholders tend to like banks with lots of capital, despite the possible impact on return on equity. That is partly because they know the banks are less likely to come knocking on the door for more cash, and partly because they are more likely to be able to pay out dividends.
And so perhaps they will eventually become just like the tasty, low-growth, dividend-paying treats that banks used to be.